Alrighty guys, in today's video I'm going to be taking you through my strategy on how I approach the London session every single day. We're going to be back testing all week from Monday through to Friday, talking about potential trades, and we're going to be focusing on two concepts being liquidity and imbalances, right? So if I'm trading the London session, let's get straight into it. I'm focused on liquidity and I'm focused on imbalances. Now, what do I mean by these two things? Liquidity, I mean swing highs and swing lows, things like this, swing highs here, swing highs here. Imbalances in the form of fair value gaps. Now, ideally, if I'm trading the London session, if you're taking notes, I like these two things to form during the Asian session. Now, everyone does it differently. For me, the Asian session is 7 p.m. to 12 a.m. So I'm looking for liquidity and imbalances during this time frame to either take advantage of, to trade towards, or to wait until these points get traded into and then take a reversal. So there's two ways you can actually execute trades based on liquidity and based on imbalances. So that's the first thing I want to mention. The second is using macros and using key time frames to execute trades. So it's all fine and well, you could have liquidity there, but you need to execute trades during a key time frame to increase the probability of your trade. So for example, if we're looking at the chart here, these are the first two things I'm focused on, right? I'm focused on liquidity and I'm focused on imbalances. Now, for me, every single day I go into the 15-minute chart. That's where I start every single day, 15-minute chart. And to make it nice and easy for you guys, I'll mark out any nearby swing highs or swing lows. So swing high here, there's a swing high here, right? Any nearby swing highs or swing lows that the market could target. This is the first thing that I do, swing highs and swing lows. And now I know in my head that the market's either going to trade towards one or the other, because we know the market only moves for two things, that being liquidity at these highs or lows, or to fill imbalances. That's the first thing. The second, I'll mark out any fair value gaps that we're currently sitting in or getting close to, right? So here we've got a big bullish fair value gap and we're currently sitting in that. That's on the 15-minute time frame. Now notice here, price has already returned to it once, right? That was the previous week or the start of the week on the Sunday. And then we return to it again for a second time here as we open up on the Monday. So the fact that we've already used it once and we've wicked through, I'd anticipate that ideally we'd respect the halfway point of this fair value gap again. Now you might ask me why. Well, it's because this has already been balanced, right? And if I want price to go higher, we should be able to respect the 0.5 level. That would be efficient price delivery. So for me, currently we're sitting around the 0.5 level. I want to see price bounce up. Now already that gives me a bit of a picture. So if you're writing notes, you're taking notes, again, you mark out liquidity on the 15-minute time frame, right? If you want to get even more specific in terms of what liquidity you want to mark out, you want to mark out the Asian session liquidity. Now, Asian session liquidity again is from 7 till 12. So if I just grab a box and I look for where 7 o'clock is, which is roughly here, all the way to 12 o'clock, which is this one here, I'm marking out essentially the high point and the low point in this yellow box, right? So then essentially, this here is my Asian buy side liquidity. And you can mark it out like this. You can say Asian buy side. And this here, this swing low, right, is your Asian sell side. And I might just mark that out with an A and an S, right? Now, from a liquidity standpoint, we've already taken out one side of liquidity, but notice in this particular day, we've left all these buy side liquidity points for taking, right? So the best and the highest probability trades, in my opinion, if you're looking to take trades at the start of London Open, are where price has left one side of liquidity there. We've rated one side of liquidity already, and we're filling an imbalance. Because at this point, we've taken liquidity, plus we've filled an imbalance, and those are the two things that the market likes to do the most, right? That's the only two reasons, right, that the market moves. So that there's your Asian buy side, right? That there's your Asian sell side, right? And this is on a 15-minute chart. Would it be reasonable for me to expect price to move down to here? Well, guess what? If price moved down to here, then price would at minimum have to come all the way down and potentially tap into this order block. So for me, I'm banking on the idea that we're going to respect this 15-minute gap. And again, I'm using this to my benefit. So I'm marking out all these things, and then I'm looking for a specific time to enter in to then take advantage of a trade. You have to trust time, because without time, it doesn't matter what happens with price. Time is really important with any strategy, whether it's London, whether it's Asian, whether it's AM session or PM session. So again, This is what I do every single day, and we're going to back test the whole week, right? Now this is the 15-minute time frame. Let's go down now to the 5-minute time frame. And I want you to notice now that we're actually sitting not only in a 15-minute bullish fair value gap, but we're also sitting on this in purple, what I'm about to draw here. This is a 5-minute bullish fair value gap, right? So essentially, we're sitting in a 15-minute gap and a 5-minute gap. Which one do I want to be respected now? I want the 5-minute gap to be respected. Why? Because that would mean we can actually push back up, respecting smaller PDRAs, and then take out this Asian buy side. So I can get rid of this now. That's the Asian range, right? We've marked out our Asian buy side liquidity, which is above this high. And that there would be our target for this strategy, right? So Asian sell side gets taken. We've tapped into a 15-minute gap and also now a 5-minute bullish gap. I want this to be respected. Now, since we've swept some sell side, let's go back in the 1 minute and let's have a look at how the macros perform, right? So there's two macros. One is before London open session. That macro goes from 1250 all the way to 110, right? Which I'm going to mark out. And then I'm also going to mark out another one, which is from 150 to 210. That's the one you want to take advantage of, really, if you're trading the London open session. Now, that's the start of the strategy, and we'll do this for every single day. Mark out a liquidity point, see where you're delivering from, and anticipate that price is going to move after taking some kind of liquidity, right? Now, what do I see here? What do I see here? I see all this accumulation here, and I see all these swing highs ready for taking. So all these points, right, are also, right, intermediate, right, or short-term liquidity points. When you look at price swings, right, and this is more advanced market structure, when you look at price swings, this whole rectangular box I'm going to draw, right, that there is a whole price swing, right, that's a price leg, right, and then within that larger price leg, you've got smaller price legs, and this is for anyone wanting to know about like advanced market structure. So within that massive price leg, you've got all these other price action movements, which I'm going to draw out here. And these also have their swing highs and swing lows associated with them too, right? I'm going to make that purple just so it's easy to see. So you've got these swing highs here, another swing high here, swing low, swing high, swing low, swing high, swing low, swing high, right? So these are the intermediate levels, right? This is the larger price structure. Inside of that, you've got internal structures of buy side and sell side liquidity, if that makes sense, right? Again, same, right, for this price leg. I'd consider from this swing high here, right, to that swing low there as another price leg. But within that price leg, guys, there's also swing highs and swing lows that can be targeted, right? So there's always internal and there's always external structure. And this could be considered as two separate price swings. And then if you wanted to go for even larger scale, guys, even larger scale here, you could get rid of these yellow boxes, right? Get rid of all these yellow boxes. And you could then consider from this swing high to that swing low as the actual structure or the price leg. So as you go up in time frames, the price legs are going to look different, right? And you can separate price legs into different structures, internal and external. And again, you can see here all these little price structure fluctuations, right, within this downwards trend, right? So all these swing highs are points to take advantage of while you're in a trade, while you're looking for long positions, right? And again, I just demonstrated how you can separate the market into different fractions, right? And it extends even on a larger time frame than this, depending on what chart you're looking at. So again, there's internal structure, there's external structure, there's swing highs and swing lows that you can target in all those kind of zones and all those kind of areas. So back to this point, let's play price out. Let's see what the macro does, and then we can have a bit of a chat and how you could execute during macros or just after the macro is formed based on what it's kind of telling us. So this macro, what it's done, it's delivered from Asian sell side, right? It's taken out Asian sell side. Now, as soon as we take out liquidity, I'm switching between different time frames. I know people don't have the 30-second chart, so I'm just going to stick to the 1 minute, the 2 minute, and maybe the 3 minute. But on the 2 minute, have a look here, right? On the 3 minute, have a look. Have a look at how the different structures look. And in particular, I want you to have a look at this on the 3 minute chart. And before I let you know what it is, in your head, write it down or say it out loud. What is that? What have we done here by disrespecting this bearish gap? I'll give you a couple more seconds. we've just created an inversion fair value gap here on the 3-minute time frame. Now, here's the thing, even though I'm executing trades on the 1 minute, if I see something in the 2 or 3 minute, it holds greater weights because there's a greater chance, right, that it's going to actually be productive in the trade I want to take. So essentially what would happen here then is if you go on the 3-minute time frame, as soon as price closes above, then you can start to look for longs technically, because you've got everything you need to fill this strategy. You've got a rate of liquidity here, Asian sell side, you've tapped into an imbalance, you've technically got your market structure shift, right? There's many market structure shifts, but this is just one that you can see, and you've inversed this fair value gap. So let's just play price out. Let's see what price does, right? That there, when you return to that 3-minute inversion, that's where you get your entry. That is where you get your entry, guys. Right, and what I'm going to do in this video, I'm going to merge different PD arrays, different execution models, just to show that it's not just one size fits all, right? You can execute off whatever PD array kind of resonates with you. So if you like inversions, use inversions. If you like bullish gaps or fair value gaps, do that. Whatever resonates with you, that's kind of what you got to focus on. So this here is a 3-minute bullish gap, or 3-minute inversion fair value gap, I should say. So it's an inversion fair value gap, sorry. As soon as price returns to that, you can go long. Now, I'm going to go even further than that and explain why you can go long from here. Why go long from here and not go long from here? This is a great question if you're watching. Why would I not go long from maybe this bullish gap, but I'd probably prefer to go long from this inversion? What's better about this inversion compared to this bullish gap? And there's a little hint I'm going to give you. It's going to be using the Fibonacci. So I'll go from this low to that high. I'll map that across in time. I want to be looking for buys below equilibrium, right? And that means I'm buying at a discount level. It just means I'm buying at a good price. That's all I'm trying to say, right? And what you can do here is you can actually get up the 0.618 and the 0.786 levels, and that's called the optimal trade entry. So notice how this inversion fair value gap sits within the optimal trade entry. That's your optimal trade entry to go long, right? So you place a long position straight away from this inversion. Where does your stop loss go? Well, there's two ways. Below the inversion fair value gap candle, which is this candle here, below there, or below this swing low. Where do you target, right? Well, that's completely up to you. This could be your low-hanging fruit, which is that previous swing high. That's already a 1 to 1.5, right? You could do that. Or you could target some of these buy-side liquidity points above, right? But I just want to illustrate the fact that using optimal trade entry, I know some people in the Discord like to use that. This is how I use that, right? If I can see a PD array that I want to enter from, and it rests within that optimal trade entry range, I'm more likely going to take that rather than taking this. Because if I take this, it'll be with minimal risk. And if I take that with minimal risk, this bullish gap, and it returns back here, I'm probably entering a second position. So it depends how you like to structure your trades, but that's one way to frame it, right? So again, optimal trade entry range. Let's just leave that up on the chart so you guys can see that as we progressively move forward. And let's keep playing this chart out, just so we can see what happens as we approach the next macro. So at this point, we're just going to wait for the setup, right? So you can see how we projected high. We already got a 1 to 2 risk to reward by entering from here. The macro delivers price. We just got to wait for it to return, right? Now, yeah, you might say this is before London Open, like I was saying previously, but there's always going to be setups during macros. Which ones? That's up to you to determine. So you can limit your chart time by focusing on macros, and you just got to see what the price has done previous to that macro to determine if that macro is going to be something you want to take advantage of. So this kind of demonstrates the algorithmic price action nature of the charts, right? The fact that, you know, any macro can deliver. It's just up to you to take advantage of the ones that make sense for you. So what happens here, guys, is this, right? Price moves to the upside, fair enough. Now, just to recap what we've done so far, we've talked about a strategy for London session. And just if you want some summary notes on this strategy, I'm going to write them out here. So if you made it this far, thank you. And we're going to write out some summary notes here. So the first note we're going to write out is this. We're going to mark out our liquidity, Asian session liquidity. We're going to mark out any fair value gaps, right? We're going to wait for one side to be tagged, plus respect a fair value gap, and then we're going to target the opposing liquidity. Simple as that, right? Simple as that. Now, this is the basis of most of the trades that I take, right? There are some variations, of course, which we can talk about as we kind of go through the other days, but this is generally speaking what we're doing. The entry model depends on you, and it depends on using macros too. So that's kind of what we're working with. We talked about optimal trade entry here. We talked about inversion fair value gaps, right? Being able to execute on that, and also market structure, internal versus external, and how you can take advantage of that, right? Another thing people like to do is they like to use the Fibonacci for the standard deviation projections. So a lot of people like to do that as well, and you just get the 2 and the 2.5 levels on the chart. Now, you can put your standard deviation tool like that, or you can put your standard deviation tool from this swing high like that, right? Because that's like the last major price swing, right? The way you can kind of get a better kind of understanding of what the last price swing is look on the 3-minute time frame if you're trading in the 1 minute, and notice how that looks like the last price swing there, right? These are very equal highs here. Technically that's a swing high here, but this is like the last major price swing. So if I just anchor the 1 to this high and the 0 to that low, I'm using the bodies. Notice how if I extend that across in time between the 2 to 2.5, that's where we have a small retracement, right? And that retracement on the 1 minute looks like this, right? So that's what it looks like. So really, you can use it as a projection tool, and say for example you're going for a long position from here, your stop loss was below this low, you could then take your profits at least, or you could go for a 1 to 2, or you could wait until you get to the 2 to 2.5 and then look to see how price reacts, and if you don't like how it reacts, then take your profits, right? But in this case, we have many opportunities to actually enter the trade for the long way or the long position, and it was all based on what happened here. So this is what started it off. This is like the fuse, right? This is what started it off. And technically what happens here, price returns to this bullish gap. Let's just play price out a little bit more, because now we're entering the next macro, which is from 150 all the way to 210, right? Cool. Now in this particular macro here, if we're having a look at price, 150 to 210 AM, this is almost like a trend continuation mixed with the typical 2022 model. So this is almost like a trend continuation mixed with the 2022 model. So essentially what's happening here, guys, if you have a bit of a look, price is coming down. We're actually taking out this level of internal sell side. Right now, what you want to do, if you haven't actually, watched the markets prior to this macro, and this is when you want to start trading, you want to look at what's happened before. You want to look at price respecting this. You want to look at the fact that you've just taken out Asian sell side, you respected this bullish gap, and you're moving upwards. You want to look at that, right? And then when you want to look at is, okay, we're entering this next macro. What makes more sense? What's probably the highest probability to take out all this trend line liquidity, or to move further down after we just respected a 15-minute and a 5-minute bullish gap? Really, realistically, the highest probability kind of outcome here is that we're going to move higher, right? Because we've already moved down quite a bit during the Asian session, and we've generated all this liquidity up here that's really for the taking, right? All low resistance buy side liquidity. Now, what you see here, if we're kind of talking about PD raise and price action and price movement, you can see price react off this 3-minute inversion. We push price back up again, right? We form this low. During the macro, we raid that liquidity, or we raid that swing low, right? And let me just go up a couple time frames just to show you a few other things. Then what happens is we inverse this 2-minute fair value gap, right? We inverse this 2-minute fair value gap. Now, you could go on the 2-minute time frame, you could go on the 3-minute time frame, right? There's a 3-minute inversion here, which I actually like better, because then what you can do, you can execute as soon as price closes above right here, right? That's your execution. Stop loss either below this swing low, if you'd like to, or below this inversion fair value gap candle, right? So you can use 3-minute gaps, 2-minute gaps, whatever looks the most clear or the most clean to you. That's what you've got to work with. And again, in this case, guys, if you're patient and you wait for the market to actually do what you want it to do, you can see that it actually returns to the inversion fair value gap here. So it comes up, trades back into it. There's your opportunity to get even a better position to go long. Again, stop loss either below this low or below the inversion fair value gap candles that make it up. And where would you target? Well, if you're on a 1 to 2, you just target this swing high here, which is your low hanging fruit. If not, again, you can hold on. So if we just play that out, look what happens at price, guys. We take out all that liquidity very, very quickly. So what that means is that all this liquidity that's generated here, that's low resistance buy side liquidity, right? Low resistance buy side liquidity. You can see our price trades back up into it. So again, this is something that happened on Monday. It kind of happened all week, right? So we're going to choose maybe Monday, Wednesday, Friday, all week, and we're going to go through the price action, how the price delivered. But this is how you read chart and price action activity, because the macro is usually going to deliver either within the macro or just after. So you got to watch to see what's happened. And then you got to look and see what's already happened before you enter in the trade. You've got to have some kind of pre-analysis. So I showed you that at the start. Right? Now, let's just illustrate this even further. And let's just get a new chart, right? So if you want to look, that's kind of what we're looking at here. And if we play price out again, then we come obviously into silver bullet. There's another macro here from 250 all the way until 310. So let's have a look what happens there. Not too much, right? But essentially this would be opportunity then to move on and to wait for the next macro. So if nothing really happens in the macro you're looking at, then you wait for the next macro. And that's how I kind of approach the charts, because otherwise it's going to be quite tricky. It's going to be quite tricky to execute, especially when you're trying to, take these trades and you're waiting and waiting and waiting. All that's happening here, we're just generating more liquidity, which in my opinion will get taken out at some point, but doesn't have to get taken out during this session. So that's really important to consider. If we've already initiated this bullish order flow, right, and it's so heavily bullish, and we haven't had the ability to come down, it might not even happen until later on, right, which is something that you got to consider. So again, if you're waiting for a sell position here, do you get a sell position? Well, maybe you get a sell position here, but look at how price action is quite choppy as opposed to right here, because the overall target, guys, has already been achieved. This swing high here and this swing high in particular, this here is your Asian buy side. Once the liquidity target gets achieved, often the market's going to be quite choppy. And it's quite easy here to think, oh, I'm going to go long, then I'm going to go short. Whereas down here, you can see that it's really one-sided. It's really one-sided. So once the price action is delivered to its target, usually it's the chance just to go, okay, well, I'm leaving it for the day, or to tape read that price action session. So I hope that kind of makes sense. So talk kind of about that session there. Let's move on to the next session. What I might do, I might just get a fresh chart, completely fresh chart here, just so you can see what I'm kind of looking at and what I do, right? Completely fresh chart, and let's just go, to be honest, let's do something different here, right? Let's go maybe even here to like the 15th. Right, let's have a look. Alright, so here's the 15th, right? 15th was one of those interesting days where if we look at price action and we mark out the macros, so let's just get these in check here. So there's one here from, again, 1250 that I marked out previously, all the way to 110. And then there's another one from 150 to 210. So let's just see what those two macros do, because I think that's important to look at. Now, if you look at this first macro, what does it do, right? It comes down and it takes out this level of sell side, but it leaves this level of sell side here. So you might be thinking, well, what's going on there? Why is it doing that? You've got to take a step back and kind of have a look at what's already previously happened. So again, let's go to the 15-minute time frame. And just looking at what's happened with price here, let's have a look. Have a look at this. This is called a balanced price range. So you got this big bearish gap here and then a big bullish set of candles. So essentially this zone here is a balanced price range, right? And that's on the 15-minute time frame. That's a balanced price range. All that there, technically this section, because that's where they overlap, right? Now technically this bearish fair value gap, right, if I just make that the full thing, that becomes an inversion fair value gap on the 15-minute. The fact that price didn't even return to this portion, right, this bullish gap, it just indicates that price is extremely bullish. And you can see that with how price action has delivered, right? You can see that with how price action has delivered. Now, this is on Wednesday heading into Thursday, right? Wednesday heading into Thursday. Now, a lot of people ask me as well, like, do I use higher time frame? Do I use the daily chart? What time frames do I look at? Well, intraday when I'm trading, usually it's in the 15-minute. But let me show you an example of where the daily time frame may be important just with an illustration or an example of what's kind of happened with price, let me just get rid of this bar replay and then we can talk about what we've seen. So this here was Monday, right? So Monday and Tuesday, price came down and it tapped into this section here, which is a volume imbalance. So this is what I mentioned previously on the last live kind of masterclass. I mentioned price, if I wanted to retrace, then come back down to here. We've done that beautifully, push back from that, great. Then on Tuesday, right, we had this massive rejection coming into Wednesday. So my eyes in my head said, okay, well, if I'm looking at price action, again, if I'm looking at premium and discount, and let me just kind of get this up for you. If I'm looking at this high to this low here, right? This high to this low here, and I draw like a rectangle like this, right? If I make the top portion of that zone green, right? And then I make the bottom portion of that zone red, I'm essentially looking for anything in the green section that price could be pulling towards as soon as we reach this point at the bottom here. So if you've heard of discount and premium, this is how you can use, I guess, the higher time frames just to get a bit of a gauge of what's happening with price, right? So again, if this is the whole price swing from this high to this low, that's the dealing range on a higher time frame, then what I can do, I can just get out my 0.5 level here just so you can see, right? And we can just fix this up a little bit just so it's a bit more accurate. But essentially anything above the 0.5 level, we're looking for any PD arrays that price could be reaching for. The only PD array that price could be reaching for was this volume imbalance here. So again, on Tuesday, we saw price come back down into this volume imbalance. If we're going to project higher, because look at how the candle closed. We came back down and we closed up here. We closed back in this order block, right? This whole candle is an order block. So again, if you're reading the daily chart, this is how I read it, right? And this is kind of what ICT taught. And this is how you can use higher time frames just to get a gauge of where price should go, or whether or not to expect more volatile price swings or less of a price swing depending on what the market structure is showing you. So Tuesday we come down here. When we close like this with this wick, my eyes go to this volume imbalance because that's a PD array that sits above the 0.5 level in a level of premium. So again, anything above the 0.5 level, that's called your premium. And then anything below is called your discount. It's called your discount, right? That's kind of what we're looking at, if that kind of makes sense. So once we move from premium back to discount, then we're looking for PD arrays in the premium zone, right? Once that happens, when we reject back into discount, we're looking for PD arrays in the discount zone. So that's kind of what we see. And again, price perfectly comes back into that volume imbalance. See that? Back into that volume imbalance there. And you can see, right, that we respect that with the bodies and then we reject back down. Where do we push back down into? Into this candle here, which I'm going to outline in yellow. And this candle here is a bullish order block, right? The whole thing is the order block, right? So again, we're watching price action, seeing what it's doing. So from Tuesday, right, and this will go back to Wednesday in a second and Thursday and so on. From Tuesday, based on that candle closure, based on the reaction from that volume imbalance and that order block, I wanted to see higher prices because there's a thing called daily profiles and weekly profiles, and essentially there's a range of them, right? And one of the common ones is Monday, Tuesday heads in one direction, and then the rest of the week heads in the opposite. So that's kind of what I was aiming for here in this case. So I hope that kind of makes sense. That's just a short kind of high time frame lesson in terms of how you can read the price action on the daily chart. You know what I mean? So again, that's what I was looking for. And now we're kind of sitting back in this zone. I'm watching a couple things if you're curious. So I'm watching the top of this wick, right? I'm watching the 0.5 level of the top of this wick to see how we kind of open after that. And I'm also watching this whole order block. So this order block, you can measure the whole thing out. And there's a couple points that are important, right? You can get the quadrants like the 0.5 level, the 0.25, the 0.75. But really you want the 0.5 level to be respected in terms of a candle closure. Otherwise, you'd anticipate it to dig further down into here. So that's kind of what we're seeing at this point. But enough of that for now. Let's now go back onto a new chart And let's go back onto what we're talking about previously, which was, I think it was Wednesday's session, right? So let's go back into Wednesday's session, back onto the 1 minute chart. Let's get rid of these volume candles, we don't need that. So hopefully this, has been quite insightful for you guys. I'm trying to mix quite a few concepts. I haven't posted a video all week, so I'm trying to get a few videos kind of in context of one another. And let's kind of talk about this day here. I think it was Thursday. It was either Thursday or Wednesday. I believe this was the one here. And if we just go to replay mode, again, we talked about in the 15-minute time frame, you've got this balanced price range. The fact that we didn't return here was extremely bullish. So now let's go to the 1 minute time frame and let's have a look at the macros. That's kind of where we got up to at that point. So again, 1250 is the first one, all the way until 110. Now during that macro, what do? We raid this level of sell side, which is internal sell side. So again, guys, when you're looking at price swings, and this is like advanced market structure, this here that I'm marking out in yellow, that there's a price swing. I'll mark it in green actually, because that's like an upwards price swing. This here in red is also a downwards price swing, right? So can you see that? Then in red again, I could draw another box from this high down to this low. That's the next price swing as well, right? So with each of these price swings, I'm seeing how price is reacting in each of those areas. So for example, if I get this big bullish price swing here, and I use my Fibonacci from this swing low to that swing high, again, I'm just getting the dealing range of that price swing, and I get the optimal trade entry levels out. We actually tap below the optimal trade entry, and then we come back up into that zone, right? So notice what price action's doing here. We're respecting that area. We've rated this liquidity, and we come very close to, but we don't tap into that area. We don't actually tap onto that liquidity point. All we do in this case, guys, is we tap onto this 5 minute order block. So again, it's really important to switch between time frames just to see what price is doing. So we're tapping back onto that 5 minute order block, and then how that looks on the 1 minute time frame is this, right? So again, price structure, price delivery. This might be a bit complex. Let me know if you've got any questions. But this is how I'm reading price in my head. I don't necessarily draw out these boxes, but again, this shows you the external structure in this case, and then the internal structure again would be all these swing highs and swing lows that you see. So when you read price action, there's always going to be this kind of price delivery where there's all these swing highs and swing lows that are internal, right? That you're going to make a judgment of how you're going to execute based on this price delivery, right? But overall, this whole section is an accumulation section. Can you see that? This whole section is an accumulation section. It's a brief pause, a brief momentum, brief pause and momentum pause. So all these highs here, they're relatively equal, right? All this zone, if I just drew a rectangle, all this zone here represents relatively equal highs, right? Because they're relatively equal. We've kind of stuck around this zone, There'd be so many traders here looking to go short and looking to go short and then short again. So the amount of stop losses that probably sit just above this zone, maybe roughly in this area here that I might draw in like a pinky color. So many stop losses here. And that's why the market just absolutely obliterates to the highs and trades aggressively higher, guys. So that's another important factor to consider. So far we've talked about entry models, right? The typical entry model, the Asian sweep of liquidity. We've talked about higher time frame structure, internal structure here as well, right? So this is kind of like a masterclass that we're doing. This here is an order block, right? Which we can mark out just in this color, 5 minute order block, and we just rated liquidity. Now the question you might have for me is, well, why didn't we take out this swing low? Because that's Asian sell side. Why didn't we take out this swing low or this swing low or this swing low? Well, because there's a balanced price range. So there might not be a need for price to come back down to retrace into this area, because you can see it, right? It's a balanced price range. And then if I go back to the 15 minute, it's a bit more clear. That balanced price range, by the way, delivered from this 15 minute bullish gap. So we've actually delivered initially from this bullish gap. We've created a balanced price range. There might be no need to return to here because that's balanced. Initially, it's inefficient in buys. Now it's efficient in buys. So that's all balanced. So now we can continue with the overall trend, which in this case will be bullish. Again, we talked through those daily profiles and the fact that Monday, Tuesday came down, we tapped into that volume imbalance, and then from there we retraced back to the upside. So that's kind of what I see here in price action. And that's kind of using a higher time frame perspective. So on this day, like all other days, right, throughout the week, this first macro was kind of the turning point for price. And this macro is before the London open session, which is 2 o'clock to 5 o'clock in the morning. So it's one of those things where sometimes you're just going to miss out unless you want to execute trades earlier, and some people are okay doing that. Like sometimes you're just going to miss out. That's what's going to happen in price. And I guess if you just go, say, to a 3-minute time frame, and even like a 2-minute time frame here, so you can see where you can see what price does, like beautifully what it does here, guys. It returns to this bullish gap during the macro, it raised liquidity. We return to this bullish gap. How do we actually react in that fair value gap? Well, guess what? We actually respect. Look at this. Look at this. If I draw at that gap, the bodies respect the 0.5 level, and then we progressively push up higher from there. So switching between any time frame, the 2-minute, you could even look at the 1-minute here. Doesn't really matter too much because there's different ways to execute off different time frames, guys. For example, let me get rid of this. What would you call these two candles here? Look at this, that's like a breaker. So rate of liquidity, these two candles form a breaker block, right? There's also a fair value gap down below, which price delivers from, right? So you got your breaker, you got your fair value gap. And essentially that could be opportunity to go long if you want to enter before that time zone. If you're waiting for the London open session, let's talk about what price action does in the London open session and maybe how you could take advantage of a London open session trade, right? A London open session trade. So with a bullish bias, again, this is where if you had the higher time frame perspective on your side, you could take advantage of it. For other people, this here would be the extreme point of buy side and you kind of just wait it out, right? For me personally, once the extreme point of buy side is taken, I like to tape read and I like to just wait it out. Again, from a higher time frame perspective, we can see now why we progressively moved higher. So if we then go to the next macro, which is from 150 all the way until 210, which is right here, what does price action do here that's important? We have an impulsive move up, right? Let's mark out all the PD arrays that we can see here. We've got a bullish fair value gap that you can see there that we're actually using multiple times. These two candles here represent an order block. This space is a volume imbalance. The fact that we trade past it and then back into it, it becomes an inversion volume imbalance right there. And you've got an order block. So technically there's 3 PD arrays. So again, if you want to execute trades, having 3 PD arrays is the strongest way to execute from. And here you've got the 150. You've got the 1:50 AM to the 2:10 AM kind of range, and that's your macro. So 1:50 to 2:10 AM. So that's your macro there. So this video, quite long, break it up into sections. I'm going to include everything that I was going to include in multiple videos just in one for you guys to kind of watch. So again, that's the macro. How do you execute off this? Well, look at this. We raid internal liquidity. So we still raid liquidity. We respect an inversion volume imbalance, a bullish gap, and an order block. How do you execute? You could do almost a turtle soup entry in this case. This is where the turtle soup would be relevant because as soon as we reject here, right? As soon as we reject here, we come back down and then we close here. There's your opportunity to go long. That's your turtle soup entry. Considering the fact that we've been extremely bullish on a higher time frame, you've got that perspective. The first macro is already delivered and showed you where price wants to go. We've got a balanced price range here on the 15-minute that delivered from a 15-minute fair value gap. Plus, we've got all liquidity points to target in terms of stop losses. So this stagnation, this to me does not look like a market structure shift to the downside. And hopefully it doesn't look like that to you either. You can see there's not enough pressure to move lower. The algorithm still wants to move higher. So if you execute here, where does your stop loss go? Well, you can put it below this order block. Because again, if 3 PD arrays are disrespected, your stop loss is probably next, right? That's a good rule of thumb. If 3 PD arrays are disrespected, bullish gap, inversion volume imbalance, order block. Well, your stop loss is probably next. So if you just go one tick below there, that should do enough for you. And you can see then you get that 1 to 2. You get kind of whatever you need in terms of a risk to reward during that particular macro period. So, just goes to show, guys, macros are important. Having an understanding of what's happened prior is important. This week it was all trend continuations. That's 2 examples. Let me just go to the previous day just to show you kind of how the previous day looked as well. All trend continuations, guys. All trend continuations. And a lot of the trends started, before the actual 2 o'clock time frame for London Open. Now here's another one. Look at this beautiful liquidity. Look at this beautiful liquidity. All of that is low resistance buy side liquidity. That there is trend line liquidity. Now, if we mark out again the same macros that I was talking about, and we do the same kind of thing, and we go from 1250, I think we're using 1250 to I think it was 110. What happens here? Very, very similar, guys. Very, very similar to the previous day. Have a look at the previous day. Just have a look at this for a second. Have a look at what happened during the previous day during this macro from 150 to 210 and the PD arrays that we mentioned here. We have an order block, we have a bullish gap, and we have an inversion volume imbalance. Keep that in mind. And look what's happened. We've had some accumulation, some stagnation, and then we've pushed higher. So the market repeats itself. Look at this. Look at the day before. Look at this previous day, right? Now, it's not in the same macro, but the price action still repeats itself, right? Look at this, right? Right here, by the way. And every hour has a macro, by the way, every single hour. So even if you draw a price action here from 1250 to, 1150 to 1210, the macro delivers, right? And then what's the next macro do? Right, what's the next macro do? Have a look, guys. Really, really important. We raid this level of sell side liquidity. So that's your raid. You can see that. We have an order block right here. Right, that's your order block. So price is finding some kind of support in that order block area. What else do we have here? Let me just mark this out. We have a small volume imbalance right there, which I'm going to mark out in like purple. Right, there's a small volume imbalance right there. Right, between that candle's low and that candle's high, and we respect that, right? So we've got a few PD arrays here that we can execute off, and then obviously we've got a bullish gap, right, which is sitting roughly about here. So there's 3 PD arrays here that are kind of holding price in that zone. Where do you execute from? How do you enter during this macro if you wanted to take advantage of it? We'd have to enter either from a turtle soup, like I mentioned before, or you can wait for kind of a shift up. In this case, you can wait for, a inversion fair value gap to be created, price to trade back down into that region, and you can trade that higher. But it depends what your entry model is, guys, because again, in this case, it happens even earlier than the previous day because this is not even in London Open session. So this is 12:50 a.m. right to 1:10 a.m. So just so you can kind of see, notice how price action repeats itself. It repeats itself. It repeats itself. On this particular day, the previous macro had the initial run up, and the 12:50 to 1:10 a.m. macro actually delivered price for the second time. On the next day, it was kind of a bit delayed. So on the next day, it was actually the 1:50 to 2:10 a.m. macro that had the accumulation, and it was the one that was from 12:50 to 1:10 that had, the initial push up. Very similar to the previous day, just the time frames are slightly different, but still working around those macro time frames. And guess what happens here? We push up aggressively and we don't come back down, right? We don't come back down until the AIM session, right? So essentially we push all the way back up, And again, what does the market target? Liquidity and imbalances. Here's a liquidity point. Here's a massive imbalance, right, from the previous day, which you can see, which would have been from some red folder news, maybe CPI, I believe, right? CPI news. So again, trend on liquidity is your friend, and you want to target that because there's stop losses there. And this just shows you, executions and how you can actually execute during different time frames. Even here, if we go to the next macro, right, 150 all the way until 210, right? What's this macro do? We raid some liquidity, right? We raid some liquidity here. That's your raid. would this be something I'll execute from? Well, let's have a look at what price action does. We've got an order block here, but notice here that you've actually formed two relative equal lows, right? For me personally, I probably wouldn't enter this, and I didn't, right? So for me, this is too choppy, up, down, now. This, if this occurred during a later time frame, would be something I'd probably look at as a trend continuation model, something that I've been forward testing. But you can see really, you don't get any type of reversal until roughly about this point here. So it's quite interesting how the market delivers. Now, if you've made it this far, this is probably going to be the last portion of the video. It's been quite a long video, so I appreciate you guys watching. If you have any questions with things, just send them through to the comments. Obviously, I've got the Discord. All my links should be in the end of this video in the description. I've got a free Telegram. I've got a free Twitter. And obviously, YouTube's completely free as well. But this is just some final source, right? Just some food for thought, right? And you'll see this play out again and again. I'm going to do this at the end of my videos, right? From now on, or just at random times. And if you're watching it, good on you, you get that information. So again, I like my macros. So if I mark out 450 to 510, right, this is a macro period, right? Now, what happens here, there actually is a reversal, and there actually is a bearish fair value gap right here, which would be a great entry to go short from, because you've got a bearish fair value gap, you've got an order block, and technically that could be maybe considered a breaker, right, if you wanted to. Now, what happens a lot of the time is, if it's going to really sink quickly, we always rate internal liquidity. So see that? So imagine you're in a short here. What would probably happen here is you'd be in a short position from here. Your stop loss might go above this swing high. You'd probably take some partials, or you're going risk-free here. You'd probably get stopped at break even. And then what happens with price? It goes in your desired direction, right, initially, and actually sells off. So this here could be considered inducement. It's also just considered tricking people into the market to move their stop loss early. And again, it depends on your risk management strategies. But if you still believe that price is going to head lower, and again, not to kind of point out the point again, but just to illustrate the importance of macros, notice when the next swing happens to the downside, just for your interest. That's one macro, that's the next macro. So if you're sitting in this, you've taken one partial, it's mucking around, now you get stopped at break even. Guess what, guys? Inversion fair value gap entry right there. Still to target the same liquidity point. As soon as that candle closes, that's when you go short. Where does your stop loss go? Above that inversion fair value gap candle. This swing high should be protected because it's already taken out liquidity, right? So this becomes a stronger setup now because you've already taken stop losses. You know what I mean? Because beforehand, you're just rallying up. Now you've taken out even more stop losses, which could have been yours as well. Think about that. And you can take advantage of the trade still to target your buy side liquidity points. If you want a 1 to 2, you get that. But obviously you can target more liquidity points as you go down. So it's really just a matter of reading price action. And some days are going to be really like one-sided. All week has been one-sided for the London session. So this video is solely made for the London session traders. Like, you know what I mean? Even on Friday's price action, guys, same thing. Look at London session. Even from about 1 o'clock, look at that, all the way up. We did not have any mercy. We came all the way back up. And just to illustrate the point again, right? Look at what we do here. Look what price action does. Same thing again, guys. Here is 1250. Here is 110. This macro initiates the turning point, right? This macro initiates the turning point. It takes out some liquidity, not all of it. Takes out some liquidity, not all of it, right? Reverses to the upside, and then really all you can take all session are trend continuations. That's all you can take. You get me? Yes, there's some nice, trend on liquidity here. But if you don't get in at one of these points as a trend continuation model, you're not really going to be able to catch reversals. There's no opportunity for reversals. So for anyone that takes trend continuations, a really good model to take in terms of last week, because liquidity points were there and we're kind of watching price action as we did that. So just going back here, this will be the last one. I know I said that multiple times, but I do enjoy this. So we're going to go back here and I'm going to kind of show you again what's happening with price. So you have to look back just on a slightly higher time frame to see what price is doing. So price had a little, rally down here. We respected this 15-minute bearish gap, and we tapped into these candles here, right, which represent an order block. Even this candle is an order block, right? We push past from there, we come back down, we trade into this order block zone, and then let's just go back to the 5-minute time frame. Right, essentially we just use the same fair value gap here to bounce off. So when I look at fair value gaps, if we've already traded into it once, I demand that the next time we trade back into it, if I'm going to use that as a level of support, we should respect the 0.5 level. So this is, I've never actually said this in a video, but here's something if you're still watching, right? If we trade into a fair value gap once already, then I demand that we respect the 0.5 level if we trade back into it again, right? And let me just get that text wrap up so you guys can see. Read that out. And this is kind of what I'm doing, what I'm focusing on. So again, if we trade into a fair value gap once already, then I demand that we respect the 0.5 level if we trade back into it again. Now, again, everything on a higher time frame works with more probability. So this is on the 5-minute time frame. So we trade it back into it once here. Here's the second time. I demand the second time that we respect the 0.5 level, and we do, and we project higher from that, right? Which is exactly what I want to see. Exactly what I want to see. Price comes back down here. We trade into this down close candle, which is an order block. All right, that's an order block. And again, any order block, you can measure out the whole order block like this, and you can see how price reacts off the 0.5 level. Beautiful. Go back to the 1-minute time frame. Right, you can see some price action starting to develop here. Right, we're bouncing off this zone. We're bouncing off this zone. We project higher, and then here we go. There's a bullish fair value gap there. There's an inversion fair value gap there. So in this case, very similar, guys. That first macro determines the rest of the day. And then if you want to jump into the trade, or you want to jump and take advantage of the markets, this is the next macro here. The trend's already been developed. So in this case, there's no reversals. There's no reversal patterns. So in this case, this macro, you've got a bullish gap right here. And we use that. Would I enter from there? No. Did I? No. Right, a lot of sitting on my hands this week, just watching the price action. But again, you can see how that macro delivers. Next macro, if you have a look, 250 to 310. Let me just play that out a little bit more, just so you can see what happens with price. Again, we just absolutely take off to the upside. We show no mercy in terms of people looking for sells. And really, if you're looking for sells here, there's no sell opportunity in my opinion. There's no sell opportunity because where's the market structure shift? Where's the willingness to go lower? There's no willingness to go lower. All price is doing when we're actually stepping up here. All price is doing when we're stepping up. Each swing high is just generating more liquidity. That's all it's doing. More liquidity, more liquidity, more liquidity. So this is like an early session to leave because really, we just kept stepping up. It was quite amazing actually how high we could step up. We kept respecting bullish PD arrays, right? Accumulation pockets doing its thing, right? And then at this point after silver bullet, we just kind of stagnated, came down a little bit, right? And then what happens from there? We just continue back to the upside because again, this is all engineered liquidity, guys. That is accumulation. That is manipulation to trick people to go short. And what's the real move? The real move is distribution. So this is like how you can use power 3 on like a smaller time frame. Right? So you can see how that works to take out the original accumulation here. So again, we've talked about a few things in this video. Hopefully, that makes sense to you. Last week, I know a lot of people are saying there's not many opportunities. Yes, not many opportunities for reversals during London session, I agree. PM session and AM session were much cleaner in my opinion. If you like these types of videos and you want these for other sessions, let me know as well. What I'm thinking of doing is I'll be posting in my Discord once a week. So once a week I'll be doing market reviews. Those will be very similar videos to this. Then I'll post those live on YouTube afterwards for you guys to see. But that option's always there for you. And again, if you have any questions, let me know. But until next time, guys, I'll talk to you then.